I like the title. Hey everyone, welcome to another Auto Trading Live Strategy session with Jeff Tompkins. This is your host, Richard Van Rich, with Craig Ward with us in the chat. Really excited to have you guys with us here this week. Hope you guys are having an awesome week so far. It's the first time I'm going to run our session. You'll notice your microphones are muted, so we can all hear Jeff and I talk. If you have to hop off for any reason, don't worry, this is recorded and will be available in the members area later tonight and also on YouTube sometime tomorrow. So if you're watching this on YouTube, please like and subscribe so you can catch all of our upcoming videos. And again, if you have any questions at all, there is a chat box and a Q&A box at the bottom of your screen. Just click on those and enter in any questions, and we'll get to those throughout the evening. And also before we sign off at the end, if you have any questions about your access to Trade Trend or Zillion or anything about any open or live trade alerts, email support@autotrading.com and we'll get to those sometime tomorrow. So before I bring on Jeff, let me read through the disclaimer real quick. Auto Trading and Trade Trend Zillion software is intended to be used as an information service for subscribers. It includes opinion as buying, selling, and holding various stocks and securities. However, publishers of Auto Trading, Trade Trend, and Zillion software are not brokers or investment advisors, do not provide investment advice or recommendations directly to any particular subscriber or in view of the particular circumstances of any particular person. Auto Trading LLC, including its owner, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Trend Zillion software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker and investment advisor before doing so. All right, with that being said, Jeff, are you there?
I'm here.
There you are.
Yep. Looks like my camera's flipping out again.
The Zillion thing where the background works and you turn it back on and it's gone.
Yeah. Let me see if I can get it fixed here.
How's everybody doing out there? Put a one in the chat box. Let us know how you're doing, where you're calling in from. If this is your first time on, let us know where you are. Oh, we get Jeff all situated. I'm sorry for the deep voice and cough drop mouth. I'm getting over the back end of a cold here.
Yeah, you sound terrible.
I sound amazing. You know, I sound like Barry White.
Start singing some it's a good Barry White song.
Show me my first, my last, my everything. See that, guys? You get songs and everything over here. I should change my background. Let me change my background. How's that?
Hey, you're in the doctor's office.
I
Well,
can't come to work today. I'm sick.
looks like mine's all screwed up, so we'll just roll with it. Hey, Mike, first time on. Awesome. Hey, Ed. Raleigh, North Carolina. So two mics, different mics. I've got an aunt and uncle in Chapel Hill. I'm going to be traveling there early next month.
Got a wedding to go to, right?
Yeah. Going to a cousin's wedding. Oh, we got a good group on tonight. Love it.
So here's the thing. Now, when you went to Austin, I told you to get brisket. Now, when you go up to North Carolina, you got to get some pulled pork.
Oh, of course.
Yeah.
Top of my list.
That's right.
You always give me the best recommendations. Love it.
Love to eat.
Welcome, everybody. I love when we have newcomers. It's always exciting.
Yeah.
Mike, thanks for introducing yourself. And again, welcome. We do have a YouTube channel, so all of our past weekly sessions are posted on our YouTube channel. If you want to get caught up, you got a lot of content in there to get caught up on. So that's there for you to check out, as well as all the other attendees. I know not everybody can make it every week, so he says vinegar-based barbecue sucks. He likes Western North Carolina. I agree. Totally agree. Okay, well, cool, guys. So welcome again. What's that, Richard?
I like it all.
Yeah. I agree. I mean, don't want too
I think
vinegary.
they do whole hog up there in North Carolina, if I'm not mistaken.
That's the way to go. Gotta roast that baby over. It's like Hawaiian barbecue.
Yeah.
Wow. Get that whole hog over the spit and roll it on the rotisserie. Yeah, my wife doesn't like sweet barbecue, so we have
My wife
to,
doesn't either. She does not like any sweet meat at all.
yeah. Yeah, that's how my wife is too. So, and she was actually not feeling well when we went to what's the place in Austin?
Franklin's.
Franklin's, yeah. So she tried a few bites of mine, but that was it. Hey, Linda. Linda from Michigan's on as well. Always good to have Linda. Now you're a regular attendee. All right, guys. So for tonight, we'll start out mapping out key levels. We'll review our 36-month moving average, our short strangle simulated trade that we put on. I think it was last week. We'd closed out the one from the prior one that we'd put on. Turned out very nicely. Put on a new one. And one side of that is now ready to close. So we'll go ahead and follow through with that. And so this is kind of an adjustment to that original short strangle we put on last week. And then the main topic for tonight is how to protect. Well, I noticed that I actually intrigued Richard with the topic for tonight. How to buy.
That's right.
What was it? It was how to buy a stock at any price you want, even after you bought it. It's a catchy title, but it's true.
It is.
Sounds kind of like hypey and unrealistic, but I'm going to show you how to do it. We always reveal the best investment. Yeah. So it serves a dual purpose. Basically, it helps you protect your trades from the onset, but also allows you to lower your cost basis through an adjustment technique. So we'll kind of walk through the steps of how to do that as our main topic tonight, and then we'll open it up to ticker roundtable and wrap up with Q&A. So let's go ahead and get over to our charts and see what's going on in the markets. So continuing to ride Mr. Toad's wild ride, right? It's yeah, I think that was a Disneyland ride, but it's basically the condition of the markets right now. So it's a lot of volatility, a lot of indecision, a lot of whipsawing, and difficult to navigate market conditions. So we're here to help with that. And we'll start by mapping out, the key horizontal support and resistance levels, what to watch out for the remainder of this week and into next week before we meet again on Tuesday. Actually, I take that back. We are going to be at a conference next Tuesday. We're attending the Money Show in Orlando. So we're going to not be here next Tuesday, but we'll let you know.
The one after that.
Is it then? Oh, you're right. Sorry. I had my weeks off. We will see you next Tuesday. It's the following Tuesday that we won't see you. That's why I
was like, no.
Keep in check. Yeah. No, sorry about that. We will be here next Tuesday. So the week after, we'll be at the Orlando Money Show. And hopefully some of this volatility will die down by then. So this week we have, bank earnings. That's largely what's dictating the movement in the market, and hopefully can get us out of this this pit and really a triple bottom that we're seeing right now. So let's take a look at the S&P 500 index and the key levels to watch for the rest of this week. All right, so as it relates to today, we closed at a key support level. That's right around a quarter century mark, 37.25. Because we do look at these century marks very closely, let me a little bit better. We'll make it more of a support zone around 3,700 to 3,725. So particularly for tomorrow, we'll want to keep an eye on the support zone. You'll notice that obviously today we traded much lower into roughly the 38 or 3680 level. And then we had buyers come in where we had prior resistance and propel prices higher on the close. And looking back into like July, even into like mid-June, we see a lot of price action around the support zone. So this is going to be key for this week. All right, are we going to be able to remain above this zone, or are we going to close below it? So if we do close below, the expectation is, if we break out of this zone, is a retest and then another move, another leg, lower, another move back down into the 3,600 to roughly 3,650 support zone. So that's, one potential outcome. If we can sustain prices above this 3,700 to 3,725 support zone, and we start to see positive price momentum from this area, then we're looking at a rotation higher into previous resistance and support going back further in time to May, into the 3,800 level. So 3,800 is important because we have a confluence of horizontal static resistance and dynamic resistance as the upper 2 standard deviation band moves into that horizontal static level of resistance at 3,800, also being a century mark. Okay, so we'll keep a close eye on this because if we do get a rotation higher into 3,800, that's going to be a difficult level to break through. And if that occurs, if we can break higher through 3,800 on the S&P, that really opens the door to much higher prices in not just the S&P, but probably the broader indices. So near term for the rest of this week and leading up to our session next Tuesday, these are the key support and resistance levels to watch. So resistance is very strong. Resistance resides around 3,800, and then we have the support zone between 3,700, 3,725, which we're again encountering on the close today, and we'll likely see reaction around that zone tomorrow and through the rest of the week, potentially, kind of depending what happens. The VIX, as we'll look at here shortly, will give us some clues on that as well. But before we get over to the VIX, let's look at the NASDAQ 100 ETF, the Qs. Okay, and so looking at a daily chart of the NASDAQ 100 ETF, the Qs, also presents kind of an interesting scenario as far as resistance and support. A bit different than the S&P. We often see the major indices move in conjunction with each other, and we find confluence between key support and resistance areas across the indices. A little bit of a different picture here with the tech sector. So we rejected and sold off from a major resistance level today, which provides more of a bearish case for the NASDAQ 100. But similar to the S&P, we did trade down into a key support level, and buyers came in and propelled prices a bit higher from the low. So if you look at the close today, trading into this support level, right around 270 on the Qs, which just very recently served as prior resistance. And then before that, again, support. So we're sandwiched in between this very significant support resistance zone, which will provide a lot of more clarity, I think, moving into the trading day tomorrow and through the remainder of the week, based on whether we can get a sustained move out of this SR zone, support resistance zone, to the upside or downside. So the expectation is if we can break and close below the 270 level on the Qs, or sorry, not can, we don't want to probably, unless we're implementing a bearish strategy. But if we do that, then we're looking at probably a test of the 260 support. And if we can break above the resistance level, which resides around 275 to 276, then like the S&P, that opens the door to more room for higher rotation into upper resistance. So that's going to be kind of right here around the 285 level. So we're sandwiched in between this very significant zone of support and resistance, and continue to experience a lot of volatility, wide ranges between highs and lows, not a lot of directional price movement. So you'll notice that we're seeing these, very volatile up days followed by a volatile down day, a little bit of indecision. So again, difficult conditions to navigate. But I think what can help us with that is always look at the VIX, the CBOE volatility index, because it often provides a clearer picture and more foresight than the indices do alone. So if we, and we've really emphasized this on many past sessions, as you can see why, because even going back into late last year, as we spike up into these levels between roughly 34, we have some outliers here up closer to like 38, 39, but 34 to 35 is a very significant resistance zone on the VIX, and has been particularly this year. We don't see the VIX spend very much time in this zone, and obviously the proof is in the historical price action here. When we look at VIX spikes into the 34 to 35 zone, we spend very little time there. Might be a day or two, and then there's basically two possible outcomes. We reject it and we rotate lower, or we break through it and start really making significant spikes in the VIX above these levels. We haven't obviously seen that this year, but that typically takes a very significant catalyst and market sell-off to spike the VIX above this resistance zone, and is uncommon. So as we saw the broader markets, bottom out last week and then rotate higher, it was in conjunction with the VIX spiking into this resistance zone. And it actually gave us, leading indication of that rotation higher. So very, very important to watch this, because again, we don't spend a lot of time up in this resistance zone on the VIX, and as we see the VIX rotate lower, we tend to see the markets rotate higher. So if you didn't attend last week, this is what we were, because this was right around the time of our meeting last week, as we were trading up into this VIX resistance zone, and we analyzed that and informed you that if you see the VIX rotate lower from this resistance zone, expect the markets to rotate higher. That happened. So you can see how this really gives us good leading information and insight into the broader markets and what their likely path is in the near term. So where it gets a bit more tricky is as that rotation lower occurs, where are we looking for price to stall out, because the VIX is inversely correlated to the S&P. So if the S&P is rotated higher and the VIX is rotating lower, where might we find resistance? Where in the case of a bear market like we're in now, in the S&P is moving up, the risk, there's still a lot of downside risk in the market. So we use that information to tell us whether we're in a bear market rally and VIX is going to come down into support and then ultimately end up spiking up again while the broader indices rotate lower. So that's where support comes in on the VIX. So as we look at these past spikes, and then not just how they serve as resistance, but how they serve as support, where might the VIX come down and find support and lead to another volatility expansion? So the 29 level is one to watch for this week, because we're moving down into the prior level of support resistance that resides below the current VIX price rate, which today closed at 30.50. So if we see the VIX hold this 29 level and then rotate higher again, that's our indication, probably a bear market, bear market rally. And we should be watching for key resistance levels that we just mapped on the S&P and the NASDAQ 100 per rotation lower. So again, just always remember the inverse correlation there with the VIX and use it, because it's one of the few leading indicators of market direction for the indices. So those are the key ones to watch for this week on the S&P, the NASDAQ, and the VIX. All right, so any questions, guys, on the market overview, analysis, the key levels, how the VIX relates to the indices, anything of that nature?
Looks like nothing's coming. I think everybody's just kind of watching the market, kind of seeing what's going to happen next.
Okay, so let's take a look at the 36-month moving average, because that's more of a medium to long-term indicator and one that we've been following closely over the past week. So let me switch over to move these. So we're just adding a simple 36-month moving average or I should say 36-period moving average to a monthly chart. So it's a 36-month moving average. We've covered this extensively in past weekly sessions. So then we're going to want to switch over to a monthly time frame. And so this is something that is important to monitor regularly, whether you're trading the indices or not, for broader market sentiment and direction and trend, etc., as well as dynamic support and resistance. Historically, the 36-month moving average serves as significant dynamic support for market pullbacks, bear markets, market crashes. This was the COVID crash back in early 2020. But you can see even in secular bull markets like we've been in for over a decade prior to the bear market of 2022, we've seen a mean reversion into the 36-month moving average. And it's been particularly extreme this year, right? But key point here is that we've encountered this now in 4 of the last 5 months, the 36-month moving average. initially in the first two of those 5 months as support. Last month in September, breaking it. And again, we're looking at the S&P 500 index. We'll look at the NASDAQ as well, and closing below. So what's happened in October so far, because again, remember, this is a monthly chart. So the candle or the price action for this month's candle is not complete, right? So we have attracted buyers in the market from a lower support zone, which is right around 3,400 to 3,550 on the S&P. All right, so you'll see that this month we've sold off into that zone, and those were previous resistance levels and highs from back in early 2020. Then we saw a couple months of resistance there, mid to late that year, before really accelerating in the months that ensued. So this is really probably the technical reason we're seeing buyers come in the support zone. But what really holds more weight is that we are trading below the 36-month moving average, following a reversal higher from it. So typically, if we're in a bull market, a secular bull market, and we're in a longer term uptrend in the markets, and we see a mean reversion into the 36-month moving average, we will see a test of it and then a quick rotation higher. And even in the case of a black swan event, like in early 2020 with COVID, while it was a bit more extreme and certainly a close below, we still see a quick rotation higher. Okay. So what changes in a bear market is that we either see a quick rotation higher and then a failure, or we see just an outright failure with no rotation off of it. So we saw the former. We saw a bit of a fake out, a rotation higher from the 36-month moving average, which again, by the way, is selected based on average lengths or terms of a secular bull and bear market. So it's not like a randomly selected moving average period. And so when we see that occur, the expectation is that we're more likely to see a medium to longer term sustained bear market or regression to lower prices. And just kind of to point that out here, if you look back, we'll go back 20 years. All right. So again, historically, assuming geopolitical, economic factors, all these things, really as of right now, inflation, are favorable for a continuation of an up move in the market. This is a great opportunity for buying historically. When that's not the case, if there's more of a macro catalyst, like back in 2008, when we had a huge housing bubble and the housing market crashed, this probably historically, as we move back in time, is the closest relation as far as market conditions that we've experienced prior to entering the secular bull market. So as we entered this housing bubble back in 07, 08, you'll notice that we had a very similar occurrence where we tested the 36-month moving average and closed below, and then subsequently rotated a bit higher off of it, and then it failed dramatically. So again, we're not by any means trying to predict the future exactly based on historical events, but it's something to consider, because if I went back even further, this is going back to the dot-com bubble, a very similar thing happened. So when we get in these situations where there's significant macroeconomical events, like in this case the housing bubble, in this case the dot-com bubble, And now let's just call it the inflation bubble, right? We're experiencing inflation that we haven't seen in over 40 years. Those are catalysts that can push markets lower for much more sustained periods of time. And that's where the 36-month moving average comes in. So if we see rotation higher followed by a failure and close lower, we need to be very cautious as it relates to the downside. The risk to the downside right now is very large, very large. So that should aid us in decision making for hedges, for long portfolios or retirement accounts, for bearish speculation strategies, and all of these things. Because what have we also seen in October? So, when you look back on it, it's almost magical, right? In October, so we opened down here, right above 3,600 on the S&P. We're currently trading on the close of the day 37,1998, but we hit a high almost right on the nose at the 36-month moving average. So and I mean, look at the reaction around this level historically. So is there sound rationale behind using this as dynamic support and resistance? Absolutely. And I mean, historically, going back decades, this makes the case for that. So you'll see that we've hit resistance on that this month and we've closed lower. So right now, the weighting and the probabilities point to a close below 38 right now. The 36 period moving average on the monthly chart of the S&P resides at 38.1092. So the probabilities right now point to a close below 38.1092 by the end of this month. And if we do close below, now if we close above, we'll have another conversation on another week, because that would shift the sentiment to bullish, but it's less likely for that to occur. And particularly if we get that close below 38.1092 or whatever the 36 period moving average resides at by the end of October, that is again a negative sign for the markets, and we'll be positioning ourselves for a continued move lower in the major indices. So spend a little more time I was planning to on that, but I think it's kind of important to hammer that in, and to continue to watch this on a monthly basis. If you're not, it's a good one to keep an eye on. On the NASDAQ 100, we're far below. So the odds of us closing back above the 36 period moving average are very slim by the end of this month. And we can actually look at the probability of that on the options chain. So if you look at probability of touch or probability of closing above that strike, that will tell you the odds, and they're very small. And if you don't know how to do that, review our past weekly sessions. We demonstrate how to actually look at the mathematical probability of closing or even touching a higher or lower price point on an optionable security. And we've got some very significant static horizontal resistance as well, around 12,300 on the NASDAQ 100. 12,000 particularly because it's a millennial mark, but pretty bearish right now as it relates to medium to long term. So yeah, we could see bear market rallies up into these resistance levels, but the key takeaway is exercise caution in how you react to those or how you plan for them, and then react to them, because the likelihood and the risk really is to the downside, not to the upside. The benefit is not to the upside right now. We've really got to where things will change. And again, if you look back on the 36-month moving average historically, is when we are trading multiple months below this key moving average. When we can finally close back above it, that's where things tend to change and we get out of the secular bear market. So again, looking back at 08, remember there's the fake out, there's the multiple months below the average, and then finally close back above, and then we go into the huge secular bull market. So as kind of dire as this seems, it's also, where we end up as it relates to the 36-month moving average, or when we end up above it, is going to create huge amounts of upside potential at some point. And that's probably going to take shift in Fed hawkishness, dovishness, and shift in inflation numbers. We're going to need to see CPI come way down, or at least start to rotate lower, and all these things. That's going to take time, but the market's going to lead that. So the market will take off and go back into a secular bull market before inflation comes back down to pre-inflationary levels. And on the other end of it, it tends to front run it. So, I mean, inflation was already very high at the start of this year, but look where the NASDAQ was trading. It was way up above 16,000 with high inflation. So the market tends to move far beyond what it should, and then it tends to reverse back on its upward trend before things get back to normal, so to speak. So so there's a 36-month moving average. Any questions on that, Richard? And then let's review the strangle
Lynn had a
trade.
question about the SPX. She was saying, where she's saying the 36 moving average on the ES. So can it stay below 38.10 for a while, but should not close below 38.10 by the end of October? Is that right?
Well, of course, we don't know what's going to happen, but that's the dynamic resistance point. So keep in mind the 36-month moving average, it's going to be relatively slow moving because it's a 36 period moving average, but it's relative to the time frame that we're looking at. So if we put a 36 period moving average on a minute chart, it's only going to it's going to be relevant to a 36-minute period. Since we're applying it to a monthly chart, it's going to be relatively slow moving. So this average will move throughout the month, but it's not going to move tremendously. Even after this huge rotation lower last month in September, at that time, the 36-month moving average was at 37.91. So it's only gone up, less than 20 points. So it's not static, but it is a dynamic resistance level. So we want to, consider it that way, and then look at where the index, sounds like the question was about the S&P, closes relative to it at the end of October. So currently it's serving as resistance because the S&P is trading below that moving average. And if we close below it, it's going to strengthen the level of resistance at that price, whatever the closing price of the moving average is at the end of the month.
Gotcha. And Keith was just kind of throwing in the fact that, not to mention the pending interest rate increases, could potentially also.
Yeah, good point, Keith. So, and I'm glad you brought that up, Keith, because the thing with the rate hikes, they actually are a surprising, amount of the, I don't know how you'd really want to phrase it, but the whether it's fear of the rate hike or I guess the impact it might have on the economy is actually largely built into current market price. So what really ends up happening is you get the surprise factor. So there's the expectation of a rate hike based on the Fed meetings, and we had one, it was last week, right, that we focused on in our session last Tuesday, where there was no rate hike decision made, but there was Fed minutes where they basically market reaction is based on sentiment from the Fed chair speak. So whether it's hawkish or dovish, that often dictates the movement because people are basing, not just the CPI report, but the way that the Fed is presenting their hawkishness or dovishness as the potential for an expected hike. And then, of course, there are analyst projections of rate hikes. And so what happens is because of all of those things, they get built into the market sentiment. So by the time the rate hike actually comes around, it's already built in. And if the rate, so if we're expecting, a 3/4 basis point hike, which is is now the expectation for the next rate meeting, if it comes in at that, it's probably not going to move the market a whole lot because that was already expected. In fact, it could result in the market moving up because there wasn't a worst case scenario than what was expected. So even if it comes in as expected, that actually usually results in a move up in the market because it was already priced in. So where the real risk lies is higher than expected rate hike, and that just kind of like, we kind of saw this recently where CPI came in hotter than expected last week, right? And we saw a huge market sell-off and then a quick reversal that same day. Right. So if we go back to, the rate hike I think it was last week on the 13th, right? So we see this huge move down into a support zone we actually had really emphasized last week in our session. And then boom, rotation higher. That gets built into the market very quickly. So always keep that in mind, but very good point, Keith. Those are going to also have longer term impacting, or longer term impacts on the market direction. But again, the market tends to lead that because prices get built in. And there's a lot of reasons for that. Markets are very, equities markets are very liquid and transaction costs are low. So it's, unlike the housing market where high transaction costs and, unless you live in like California or New York, where you can, sell your house the next day to, above the asking price. It's not the case in most places, maybe if we're in a hot housing market, but in general, it's a relatively illiquid market. So it tends to lag, macroeconomic factors. But if you have a liquid market like the equities market, and these transactions are taking place, in large amounts on a daily basis, and there's low transaction costs, then the market's going to tend to lead the expectation. And that's where the whole buy the rumor, sell the news, thing comes in. But still a good point there. So any other questions? We're kind of running a little bit longer than
we're good.
Expected. So I want to get into the strategy for tonight. We got to actually, let's review the strangle trade too. So was it a few weeks ago? I think we covered the short strangle strategy, which is a great strategy for volatile markets. So if you weren't in attendance for that session, you can go back and review in the YouTube channel. So since then, we've been setting up some simulated short strangle trades on the S&P 500 index. And we closed out our first simulated trade last week. And we're just doing one contract on the simulated trade, I think for somewhere between around $2,500 profit on that simulated trade. So it can be a nice strategy because we're selling premium on both the put and the call side when volatility is relatively high outside of the expected move. So we put on another one last week. And again, in those weekly sessions, we've gone over the criteria and things for closing these types of short strangles, the criteria, the strategy, and everything, and rationale behind when and how to close these. One of those being that if you reach a 50% profit target level, so 50% of the premium that was collected, since this is an option selling strategy, that side can be closed. So that's occurred with the the put side, so in our simulated trade last week, we sold the 3,100 strike puts at 23.60. And as of the close today, they're trading at 7.35. So that on a one lot contract is $1,625 in profit. So we've actually surpassed the 50% profit target level. So what we would do is close this out and reposition the trade on the put side. We'll keep the 4,000 strike calls open for the moment. But what we'll do is we'll go ahead and resell based on the entry criteria for the strategy, which is to sell, and we'll use the same expiration. So the November 18th expiration, that those expire 31 days from now, and reestablish the put side of the position at the 10 delta. So we won't take the time to do that right now, but again, if you weren't in attendance for that session, you can go back and review how to do that. But we'll go ahead and put that in the simulated account tonight for the open tomorrow and reestablish that. So we'll follow up. Let's see here. Let me clear this out. We'll follow up with that next week, next Tuesday. See how this continues. Okay. So I apologize, guys. We ran a little bit longer on the market analysis, but I wanted to make sure that we covered all those key points. So let's talk a bit about our strategy tonight. All right, so let me get over to, I guess we can just continue to use this chart. So it's a bit of an option-based strategy, but combined with equities. So really can be used with any optionable asset. So if you trade futures, you can use options on futures, equities, ETFs, but we're looking at optionable securities here. And we're going to combine a few of our past session strategies as it relates to scaling, capital allocation, money management, option strike selection, and ratio spreads. So we're combining a lot of information here, but it's even if you weren't in attendance for those or haven't viewed the recorded sessions, fairly easy to grasp, I think. But we'll make sure there's time for questions and nothing left unanswered there. So to demonstrate kind of how this works, let's just use like a generic, just an obvious, like pick an obvious stock. We can use, I don't know, Richard, do you have any ideas? Optionable stock, demo this on.
Sorry about that. I was sending out our invite email for tomorrow.
Which we have a big surprise tonight, by the way. So stay tuned here in a second.
What was the question?
I was just curious, do you have any like a stock recommendation, optionable stock I can demo this strategy on?
Let's see. You want to look at let's see what we get in the, what you guys give us some, huh? Craig says GM, get an APA.
APA, Stephen? Okay.
Yeah, APA.
APA Corporation. Right, Apache. So all right, so again, guys, remember this is all for demonstration purposes, education. We're not suggesting that you execute this trade by any means, but to demonstrate how the strategy works. So we're not going to really focus on the fundamentals or technicals of the stock, but more so how to buy. If you're looking based on technicals or fundamentals or an indicator, whatever your buying decision is, and you bought an asset, and in this case, we're using Apache as an example. We're going to number one look at how to protect the trade in a pretty unique way that most people aren't aware of and certainly don't use. And if things work out and the stock goes up like you hope it does when you buy it, right? Then fantastic. You make money on the shares, but of course that doesn't always happen, right? So, what happens if the stock moves lower? Then what? Well, we want to have protection. For those of you who know me and have followed Altos for the 8 years that we've been around and been teaching our strategies, you know that I hate stop losses. I hate stop losses, and I almost never use them. There are much better ways to control risk than a stop loss. Stop losses are frustrating when you get stopped out and then the asset that you bought ends up turning around and moving back up the way that you anticipated, and you just lost money when you should have made money. They're frustrating when they get basically hit to the penny, and we probably all had that happen, and then the market moves back up. They're frustrating when you buy a stock, you put your stop loss order in with your broker, and then the market crashes overnight. The futures tank overnight and the market gap's lower, and your stop loss doesn't get filled because the market gap below your stop loss order, and you're in you thought you had that protection there, and then you've lost even more money. So I can go on and on. There's all kinds of reasons I hate stop loss orders. I'm not saying that they don't have their place for the right strategies and the right people. This is just my personal preference and opinion and experience with them. So
I've been hammered before. Like there was a time where I was like an NFP and I had a stop loss in there. I was like in my early days of trading. I didn't even know it was happening. And I got hammered.
yeah, I
Like
mean, it happens
blew
to
through my stuff.
happens to
Yeah.
everybody, and it's terrible. So let's look at a better way to protect, and then there's a downside to that, but we're gonna throw an upside into it. So okay, again, using Apache. So let me get the option chain up here for Apache. We can kind of demo this. All right. This over. All right, so we've got Apache. So let's say we buy right now. Apache today it closed at 39.82. All right. So let's say we want to buy shares of Apache. It's in a bit of a trading range. It could move lower, it could move higher. We don't really know, right? Or maybe we are confident it's going to move higher, but then it doesn't. So what we're going to look at is setting up a form of a ratio spread that kind of encompasses a protective put or a Mary put protection strategy with a bit of a twist on scaling or capital allocation, and then re-entering. So the catchy title of tonight's session, right, was what if you could buy a stock and then change the price that you bought it at afterwards? Well, you can if you plan for it accordingly. So right now, with Apache trading at 39.82, let's just say we're just going to use a kind of basic, just round numbers for ease of understanding. Let's say that our account, and of course this is completely individualized based on your account size, your risk tolerance, your portfolio, etc., that we could afford to buy 1,000 shares of Apache. So 1,000 shares right now would cost us what? $39,820. So that's our capital allocation, our total capital allocation. That's what we could risk on this particular trade. So that again might be different for any individual. Maybe it's 100 shares for you, or 200 or whatever. But for demonstration purposes, 1,000 shares. So we're not going to actually buy the 1,000 shares outright up front. Okay. So we're gonna use a scaling in method, and we may not even need it, but in the event of an adverse move against us, we can utilize it. All right, so we're going to actually split up the purchase of this. But before I get into that, let me actually, I don't want to get ahead of myself. Let's look at the options. So we have a number of different expiration cycles to choose from. So we want to, we can basically use any expiration cycle we want, because this option selection technique actually allows us to overcome volatility skew and a lot of these other things we've covered in past weekly sessions. But we want to select an expiration cycle kind of based on the outlook for the stock. Like if we want to, and how long we want to tie up capital. If we're okay with tying up capital in the stock for, let's say, a month, and we think that that's enough time for the stock to make a move up, then let's go out a month in expiration. We'll go to the November 18th expiration, 31 days from now. Now the stock is trading pretty, different assets are going to have different strike price availability and strike widths and all these things. Apache doesn't have a lot of strikes to select from, and they're 2.5 point widths, but that's okay. Let's round to the nearest number. So again, we closed at 830.982. Let's just assume we open at that price tomorrow. We're going to round up to 40 as our nearest strike selection. All right. Well, if we bought shares, let's just say at, and again, for simplicity, we'll just say we buy the shares at $40 at a round number, right? So the stock trade, opens at the same price tomorrow, trades up a bit, 18 cents, hits 40. We buy the stock at 40. If we, and we're going to, buy a set number of shares based on our risk tolerance and our available capital. To protect the trade, we'd have to buy the 40 strike puts. So what that does is it gives us the right, but not the obligation, to sell the stock at $40 a share between now and November 18th, no matter what happens. If the stock goes to zero, if the stock skyrockets, if it goes down to 25, whatever, it doesn't matter. Between now and November 18th, we have the right to exercise these puts and sell the stock at $40. And at 100 shares per one contract that we buy of the 40 strike puts. So that's pretty nice. Problem is, these puts are very expensive. So if we bought 1,000 shares of Apache, it would cost us about $3,200 or $3,250 at the midpoint to buy the protection. That's the cost of the insurance for 10 contracts. So that's kind of like using a stop. It's maybe better than a stop in some ways, because a stop loss, again, can be violated. We can get a gap below. We can get a fast moving market, and the broker's not able to fill it. All these bad things can happen with a stop loss. The 40 strike puts would protect us no matter what happens between now and November 18th. So caveat is they have an expiration date. So we need to be aware of that. They also have a cost, just like insurance does. We're basically protecting. So rather than just fork out again, for buying 1,000 shares of Apache, just fork out the $3,200, $3,300 to protect 1,000 shares at $40 a share. We're going to look at financing those. And in past weekly sessions, we've talked about how to do a particular type of financing using call spreads on the other side. Now, a call spread, that can be a great viable protection strategy, but it also caps your upside because you're selling calls. So another way to finance the purchase of put protection is to sell lower strike puts. Now, there's a caveat here that we're going to focus on. But let's talk about what the advantages of doing that. So if we buy the stock at 40 and we buy the 40 strike puts, we have the right to sell those shares of Apache at $40, no matter what happens, even if the stock goes to zero by November 18th. So if the stock goes up, that's fantastic. That's what we want it to do, because we bought shares of Apache at 40 and we want it to go higher. But the problem is the cost of these puts raises our break-even point and our profitability point. So now the stock's got to go up above, let's just say we buy them right around the midpoint, let's say 320. The stock's got to go above 43.20 for us to start making a profit because we had to spend that money on the puts. So if we finance the cost of these puts by selling, so again, we're the 40 strikes, we'd be buying those for protection. But if we finance those by selling lower strike puts, and we'll talk about how to do that, then we're not faced with having to overcome the cost of the put protection when the stock moves up. So if we were to sell, so these are trading at, let's say again, 320. We don't have a lot of strike selection here on Apache, but we could actually sell the 3750s and bring in a credit. So we're actually getting paid for the protection at the 3750 strike. And normally I'd probably want to go a bit lower than that. But you can see that the 3750 strike puts are trading at the mid for like, let's see, 13.6, about 210 at the mid. So 1-to-1 on a 1-to-1 ratio, that doesn't cover the price of the 40 strike puts, but we're going to use a 2-to-1 ratio. So we would sell 2 puts for every 1 put protection that we buy. Now, I know what probably a lot of people are thinking, well, that's going to obligate me to buy the stock at 37.50 and it's going to increase my risk. Well, hang on just a second. So we use a 2-to-1 ratio, selling 2 puts for every 1 that we buy. And remember, 1 contract controls 100 shares. So if we allocate 1,000 total shares that we can buy of a particular stock, in this case, for Apache, that would be, and we buy it at $40 tomorrow, it would be $40,000 plus the price of the puts. But you'll notice that if we sell the 3750s at roughly 210 a contract at a 2-to-1 ratio, we're overcoming the cost and actually collecting a credit for that spread. It's a ratio spread. And that way, if the stock goes up, and generally you want to try to do this for kind of around even money or a little bit of a credit, like in this scenario. But if the stock goes up, not only do we keep the credit received from this ratio spread, we make the appreciation in the stock as well for however much it goes up. Our upside is unlimited because of the ownership of the shares, and our protection is at 40 because of the purchase of the 40 strike puts. And those are financed by 3750 at a 2-to-1 ratio. So here's where capital allocation and risk management comes in, and scaling. So remember I said, well, we've allocated 1,000 shares or $40,000 if we purchase the stock at $40 a share to this trade. That's our maximum risk that we're willing to take. We don't want to, whether it's risk or capital expenditure, margin, whatever we're tying up and risking for that trade, that's our maximum. So since we're selling puts, if the stock does go down, we hold these puts through expiration, we're obligated to buy the shares at a lower strike. So the cool thing about this is we can actually select lower strikes. So this takes some kind of, I don't want to say trial and error, but kind of playing around with the numbers and the strikes and things for different stocks. Every stock's going to be different. We're just doing an example on Apache here. But the picture might be a bit different with Apple or with Facebook or Google or whatever we're looking at. But you can play around with the strikes and the cost. And where are you, when you tie this into other things like support and resistance levels, where are you comfortable buying this at a lower support level and tie that to the strike price? But again, we're not looking at fundamentals and technicals right now. We're just looking at the mechanics of the strategy. So we can actually select a lower price if the math works, and we can either get a break-even protection price by selling a 2-to-1 ratio put spread, or even a small credit, like in this example. We can then start selecting the price, and there's other variations of this. We could do a 3-to-1 ratio if it's within our risk tolerance, and we could go to even lower strike and sell those puts. Topic for another day. So we're just keeping this simple, 2-to-1 ratio. And let's say we're okay with buying. If the stock doesn't go up in the next month, like we were anticipating or hoping, we can, if we're okay with it, buy more shares at 37.50. So we're actually we have the flexibility to select, if the stock does go down and doesn't move in the way we anticipated, to buy the shares at a lower price. And we've just changed our cost basis. We buy our initial at 40, and then we buy the remaining shares at a 2-to-1 ratio at a lower price. So we've actually lowered our price below the midpoint between the purchase price and the strike price of our short puts. How beautiful is that? All the while, we protected it with the 40 strike puts. So if the stock does in fact move down, the premium, let me redraw that, that wasn't that great. The premium for the puts that we bought is going to go up. And if you're an options trader, or you are familiar with the Greeks, you know that move down in a security increases implied volatility, which is great for the premium if you're a put buyer. So these could go up significantly depending on how far the stock drops, but they're giving us some protection. We'll keep the premium that we sold if we're willing to hold these through expiration and take assignment of the shares at that price at 37.50. We keep this premium as well. So both this long 40 strike put and the 2 short 37.50 strike puts have provided us downside protection. Now, yeah, the stock could go way down, and that's something to consider. So the rule is we want to hold both the long put at the 40 strike and the short put at 37.50 all the way until expiration, no matter what happens to the stock. That's why I was emphasizing at the start of the presentation of the strategy that we want to be comfortable with our capital, tying up our capital for the amount of time as it relates to the expiration cycle that we select. Yeah, you can exit early if things work out and you're okay with buying back the 37.50s and selling the 40s, but generally, when you enter this trade, it's with the expectation that you're going to hold it for the expiration cycle that you select, and the stock either goes up or it goes down. So again, if it goes up, all is great. We collect this little credit that we received on this ratio spread, and we collect the appreciation in the share of the stock. Then we would sell it and get out of the profitable trade on the shares as well as the ratio spread on November 18th. But if it goes down, we're using the protection from the purchased 40 strike puts and the sold 37.50 strike puts at the 2-to-1 ratio. Now, here's the caveat. We now have to buy twice as many shares as we initially purchased when we set this whole trade up, right? So remember, every contract controls 100 shares of stock. So if we had allocated a total capital exposure of 1,000 shares of Apache at $40, that's a $40,000 capital outlay. But we don't put it on all at once, right? So we enter roughly a third of it up front. So that would be what, 333 shares. We have to round because you can't buy a third of an option contract. So again, that's why you have to play with the numbers of it. But we reserve the other 2/3 of the capital that we're willing to allocate to the trade in the case the stock moves down and we have to purchase more shares at a lower price. So then we haven't exceeded our risk tolerance, our risk threshold. We've allowed for the ability to lower the cost basis of the stock trade, right? And go to our full allocation, even if things don't go as planned and then the stock moves against us. And we've allowed ourselves to make money from both the ratio spread and the appreciation of the shares of the stock if it does move in our favor. So we're really creating best case scenarios for all directional movement. Or even if the stock stays flat, maybe it doesn't go anywhere. Well, we had the protection for 31 days. And maybe we didn't make any money on the stock, but we collected a little bit of a credit on the ratio spread. So you can see, kind of regardless of which way the asset goes, we're prepared to make the best of it. With the caveat that you really have to be diligent with your capital allocation and not exceeding your risk threshold. So we don't buy all 1,000 shares of the stock up front. We buy a third and then enter the other 2/3 of the capital allocation at the lower strike. Because if we really simplify this, and we just do single contracts, if we buy 100 shares here at 40, we need to be prepared on a move down in the stock to buy 200 shares at 37.50. So again, that'll give us the flexibility to select a lower strike purchase price on an adverse move, but also protect us on the way down, and lower our cost basis if we do make that purchase. And we can actually reestablish this whole setup after the fact as well for more protection. We just don't want to exceed our total risk tolerance or capital allocation. And kind of as a final, and we'll open it up to questions, see if there are anything we need to clear up. This can be combined on an adjustment basis with other strategies we've covered in past weeks. For instance, this might be our initial strategy for protection on a downside move, positioning ourselves for a lower cost basis on a trade, and also positioning us for an upside move. But if the upside move takes place right away, then great. Maybe we get out of the trade and we just move on to another opportunity on or after November 18th. But maybe it goes down, and we end up lowering our cost basis with our ratio spread puts, and then we need to decide, well, how are we going to protect ourselves from here? Let's say the stock goes down to 30. How do we protect ourselves from 30? Well, we'd have to buy more puts, and then finance that and set it up for success on a reversal of the stock if it goes back up from there. And then we look at the ratio put call or vertical call credit spread to finance the cost of the puts. And so we can sell call credit spreads at higher strikes to finance the cost of the puts at a lower strike and allow for upside potential. So that was covered in a previous weekly session, not to confuse anybody. You can go back and watch how to do that. So again, it can be combined with other strategies we've covered in previous weeks. So anyway, threw a lot of information at you, went over our hour allotment. I appreciate everybody for sticking with me and all your patience. I hope you got it's sinking in. You kind of get where the rationale is behind this protection and the flexibility it gives you to select your purchase price, even if the stock that you bought has moved against you. Again, all assuming these are optionable stocks. We can't use this on a stock that's not optionable. But again, a lot of information, which is why we record these and why you can go back and review, but also why we wrap up with any questions that might be lingering. So if you guys have any questions on this, please put those in the Q&A or the chat. Be happy to clarify anything.
Yeah, I got a couple. Is this strategy suitable for high volatility time, or do you want to do it into low volatility?
Fantastic question. So the beauty of the ratio spread, here's actually, and I'm glad that was asked. So here's something you actually want to look out for. And we've covered this again in past sessions, volatility skew. So remember, we want to sell high implied volatility and buy low implied volatility. So if you look at, oops, wrong one, that was supposed to be a circle. If you look at the implied volatility column on your options chain, one way to know if this is a suitable options strategy to use with the stock, the optionable stock, is the puts that you're buying. In this case, in our example, it was a 40 strike on Apache. Look at the IV on those, the implied volatility. Okay, they're 69.22%. So we're buying those. So we want to buy low IV, right? And then we want to sell higher implied volatility. So if you see volatility skew, which is basically the further out of the money in the strike that you go, the higher the implied volatility goes. This stock has huge implied volatility skew. Look at that. The at the money strike is trading at around a 69% IV. You go down to the 3750s, we're 70.6. And the further out you go, we see this huge volatility skew. So that tells us that if we're selling the 3750s, we're selling higher IV and buying lower IV at the 40 strike. So that's what we want to look for to see if this 2-to-1 ratio spread makes sense. Sorry, I got so excited about that. Can you repeat the question one more time? Because you want to look at the IV, but or was it mainly around like does it work better with a volatile stock or?
Yeah, it's saying, is the strategy suitable for high volatility time, or do you want to do it into low volatility?
So where I was going with that is because we're selling the ratio spread with the short strikes at a high IV and the long strike at the lower IV, it actually overcomes that theta risk. So the volatility risk in selling and buying the various strikes for that security. It really is not, it's really up to you, I guess I should say. That's totally your decision. The option strategy accounts for that. So as far as like whether you're paying too much or not, because we want to do this again for relatively even money or a slight credit on the options part of the spread. It's up to you. If you select a security that has the potential for bigger moves, just be aware of the exposure that you're going to have at those strikes. But yeah, you then have the potential for a bigger upside move. So totally like a personal kind of decision, and also take that into consideration with expiration selection. So if you are selecting a low volatility stock that might take some time to make a directional move, you may want to select a longer dated expiration. If you're selecting a very volatile stock that could move a huge percentage in a short amount of time, then you may want to use a shorter dated selection. So I think really that it's a great question. I think mostly related to your time horizon, how much time you want to tie up capital, and your selection of your expiration for the ratio spread.
Gotcha. Another follow-up was, in this example, they considered a covered option covered by the stock you own?
Yeah, so this differs from a covered call, where if you sell calls in order to not be naked or short exposure on the call, you have to own the underlying shares of stock. The spread actually doesn't relate necessarily to the stock because you're buying a long put. The exposure comes in on the extra short put. So again, you've got a 2-to-1 ratio. Also a great question, because this is important in consideration for margin requirements, capital allocation, and risk exposure. With the 2-to-1 ratio, it's basically, you can look at that as a 1-to-1 put spread plus a naked put. So your risk is capped with the 1-to-1 spread, because remember, this is your total spread. And your exposure is on the short put that's uncovered. And that's the one that you're adding the risk exposure. Again, so 2-to-1 ratio. So that's, again, when you set these types of trades up and you look in, your risk exposure or your order dialog box to show what your risk exposure is going to be, that's what you're going to want to pay attention to, because your risk is capped on the 1-to-1 part of the spread. But since we're doing a 2-to-1 ratio, there is naked put exposure on that one extra part of the ratio spread.
And questions I got?
Well, and that, just to add to that too, that's the reason why the trade needs to be planned up front. So you want to know what you're willing to buy, or how much money you're willing to allocate to buying shares of that stock up front, because in the case that it does go down, you need to be prepared to have that capital available to buy the extra 2-to-1 ratio of the shares at that lower strike where he's selling your short puts. So that's kind of the takes planning. You don't want to just go into it willy-nilly and then have the stock move down and you've set this beautiful spread up, but then you don't have the capital to buy the shares at a lower price. So you definitely want to plan ahead, and knowing if the stock does close below your short put strike by expiration, in which case you're obligated to buy the shares at that strike price, you'll know exactly what amount of money you'll need to buy the shares at that price, and you'll know exactly what price you're buying them at that point. So there shouldn't be any surprises unless you don't do your homework. So that's kind of the crucial part there. And well, I would definitely urge, because this was definitely more of a complex strategy and topic for tonight, everybody to go back and rewatch and make sure you're comfortable in practice and everything else before ever using real money for this type of strategy. But I think it's a great one to use if you can plan ahead and you execute correctly. It's a fantastic strategy.
Awesome. Yeah, definitely rewatch it. Jeff said sometimes these things come through pretty technical, and as you watch it, try it, paper trade it, or play with it, you'll see that it's much easier as you practice, for sure.
Yeah, and this is one too. We can look at setting up some simulated trades. I think for some of these more complex strategies particularly that involve options, it makes sense to set up simulated trades on these. So let's do that for the start of our session next Tuesday. We'll set up a simulated trade using the strategy, and we can kind of follow through and see kind of some of the nuances and how it plays out.
Steven's got a good question. Said, are you going to talk about tomorrow's special event?
Yes. So I was going to get to that, but thanks for reminding me. So guys, tomorrow we are holding a very special 2-day workshop for our VIP members. And we're going to be and we have a special guest. So Daniel Sinig, who is a PhD computer programmer and has done the development on our Zillion platform and trade trend indicators and all these wonderful things, is going to be joining us for a special 2-day workshop. So we start tomorrow morning at 9 a.m. Eastern. We have 2 sessions tomorrow. They'll run about 2 to 3 hours each, morning and afternoon. And then we're coming back on Thursday after we've taught the strategies and gone through the indicators that we're going to be using, which are all proprietary indicators we're going to be providing for the group, and teaching the strategies behind them. Going to come back on Thursday and actually trade those with real money in real time on a live trade session Thursday morning. And then we're coming back Thursday afternoon for a special extra bonus strategy that we're going to throw in. So it's a 2-day event, starts tomorrow. Probably a lot of you have been getting the emails for these over the last couple of days. We are almost sold out of the event. So we do have some seats available, but we're capping it at 100 attendees. So we're almost at the limit, but we do have spots left. So if you haven't joined or you're interested in joining, Richard will put the link in the chat for you guys. It's only $97 for the entire 2-day event. So it's less than $50 a day. You get to learn some incredible strategies and indicators and things that we use, both Daniel and me, and then actually watch us trade them live with real money, and you guys can follow along. So There's the link at the screen if you guys want to join the workshop tomorrow. Then we have a few spots left. The whole event's recorded, so if you miss any part of it or can't attend all 4 sessions, because again, we have 2 tomorrow and 2 Thursday, the whole thing's recorded so you can watch it after the fact. And of course, ask us questions and things, even if you're not able to attend live. So that's the big announcement. We're starting that tomorrow morning, 9 a.m. Eastern. Hope you guys can join us. Again, only a few spots left, so take advantage if you're interested in checking it out. And with that, are there any other questions, Richard?
No, we're all set.
Cool. Well, thanks so much, guys, for being patient with me tonight. I probably ramble a little too much, but I get excited about these things, and we had a lot to cover for the market as well. So I hope you guys got a lot out of it. I hope to see you guys tomorrow in the VIP workshop, tomorrow and Thursday. And if not, we'll plan on seeing you guys next Tuesday at 7 p.m. Eastern, same time, same place. Have a great rest of the trading week. Thank all of you guys. Appreciate all the nice comments. And we'll see you guys very soon.